Now, let's talk about interest expense and interest paid, actually. What we want to know is interest paid. Same logic here. Okay, so you need to get the interest expense from the income statement and they exclude the amount that they haven't paid yet. Same thing. So we add interest payable, take away closing balance of interest payable. Same logic. Now, if they have an interest expense from the income statement, we don't necessarily know whether they paid for it or not. So we need to look at the balance sheet to see if any interest is outstanding. So if they have interest payable from last accounting period, that means it would have been paid this year, so we need to include in the interest paid. If they have a closing balance of interest payable, that means they still haven't paid for it yet, so we need to exclude that. Income tax paid, the same thing. So you can get the income tax expense from the income statement, add opening balance of a current tax liability. So essentially that is tax payable. Take away closing balance of current tax liability. So then we can work out how much income tax they paid during the year. So the logic is the same. That's what I mean. Once you understand the logic behind it, then you can actually apply this. You can, well, you don't have to memorize everything because you understand it. Hopefully this makes sense. So another thing that I want to go through is the drawings or dividend paid. Depending on the business structure, if they're a sole trader, then they will have a drawings instead of dividend. If this is a company, then they will have a dividends instead. So this one is essentially now going back to the week 1. We have, remember, opening balance of capital plus profit during the year, or if there was a loss, then you subtract. And then add contribution, owner's contribution, minus drawings is ending balance or closing balance of capital, right? Now, what we want to know is this. Then we can rewrite this into drawings is opening balance of capital plus profit for the year and plus contribution, if any, minus closing balance of capital. That's how we work out drawings. If this was a company, then they will have a dividend paid. That is, now, instead of capital, we're looking at retained earnings because dividends will be paid out of retained earnings. Then it's opening balance of retained earnings plus profit because current year's profit will be transferred to retained earnings and it will increase it. And then minus ending balance of retained earnings. That's how we work out dividend paid. In this case, if they received contribution from shareholders, that will be shown as share capital. If their share capital has gone up, that means that, well, they issued more shares. So look at the difference between current year and the last year to see any changes. Now, so this is most of the conceptual work, and now we're going to apply this to a question.